And coming up next, Business Report producer David Weir talks with veteran Boca Raton financial pro Steve Pomeranz. Dave asked Steve about his take on the sometimes volatile moves on the stock market.
Well, there's many countervailing forces right now. You've got growth in the economy, and yet you've got still a lot of problems with real estate. So it's like in the ocean where you've got the tide coming in, the tide going out, and now you're right in the middle of that. So it's getting a little bit churny right now.
Well, you know, you're a pro. You've been in the business a long time. You know Wall Street, and you know the economy. What do you tell your clients, your investors?
Yeah, I focus on the intrinsic value of things, not so much what the prices are doing any given day, because that's totally out of anybody's control. But if you concentrate on owning good quality things that can grow over time or pay a good rate of interest, and then you just collect, you sit back and collect it, it doesn't really matter whether the thing is floating up or down in price in any current day.
I got you.
Yeah.
Well, you know, the American public, especially down here, are angry, you know, really mad at spending all this taxpayers' money bailing out Wall Street. And you know the guys up there. Some of them, we still got cons, liars, and thieves up there, but we've got some good guys also. Well, what's your comment on us bailing out Wall Street in favor of Main Street?
Yeah, well, I believe that Wall Street had to be bailed out in order to save Main Street. However, the system itself turned corrupt, as the pendulum always seems to swing too far in either direction. And now, of course, the piper has to be paid, so this pendulum is swinging back again. However, I think that taxpayers are going to get paid back quite a bit once we get through this.
Well, hopefully we get paid.
Yeah.
You know, Goldman Sachs, we paid them $19 million through, or billion through AIG that we sent in about $90 billion on that deal. You know.
However, the consequences from an AIG going under would have been just horrendous. Just look at what happened when Lehman went under.
I got you. Yeah, I'm reading a book about Lehman now going under. But do you think if AIG went under, it'd be catastrophic?
Catastrophic, sure, because they have their tentacles in so many parts of financial society that once it's like a house of cards. Once it starts to fall, everything falls.
I got you. And we'd go along.
We'd go along with it. Exactly.
Yeah. Well, you know, okay, another thing in this volatile market, the 401ks, you know, people are really angry about that.
Sure.
They're seeing their 401ks go down the tube. How can we compensate for that?
Well, I think the first thing to remember is that for a younger person, a bear market is your best friend. Because you're accumulating shares. You want to accumulate them at low prices. You want to buy things low and eventually sell them high. So most people run from bear markets, especially younger people. They stop because they've put in X thousands of dollars and now it's down. They have to see that as a huge opportunity for the future. To invest when things are high means that your future rate of return is going to be lower. So when things are low, your future rate of return is going to be higher. You have to turn the whole idea around when you're investing. Now, if you're in your 40s and 50s, you have to be a little bit more careful because the volatility, you know, can work against you in some ways, but you still have to think long term because most people are going to live into their 70s and 80s.
Yeah, that's true. Yeah. Well, you know, you run a financial management company down in Boca. What do you actually do for the clients, your clients?
Well, we basically take a look at their goals, number one. We take a look at their risk tolerance, but we also look at their psychological propensity for risk, so to speak. You know what I mean?
Yeah.
Because most of the mistakes that people make are psychological. They're not really quantifiable in the sense they get scared, they sell out at the bottom of the market, they get excited, they buy in at the top of the market. We act as that countervailing force. We counsel them to stay put when the market's going down. We were able to raise some cash before that happened, so we didn't go down quite so much. And now that the market's rising again, we're incrementally putting money back in. We're not making bets that are either black or red. We're not making these strong bets, but we're playing the averages and we're playing the probabilities better. And I think that's a more successful strategy.
Well, how do you charge your clients?
We're fee only, David, so we don't participate in any commissions or any charges. We custody our client's asset at a discount brokerage firm. big one that everybody knows the name. And then we just earn a fee for managing the money, or we charge by the hour to make recommendations if people don't have the assets to put with us.
Oh, that's what I was going to ask you next.
Yeah.
You know, okay, again, the working class, not the big wealthy clients. You can you handle those people.
We absolutely do. Because I do this radio show on NPR and WXEL, a lot of people have come to us who don't really have the assets to attract a top quality investment advisor, but so we decided to use our skills and help them do a financial planning or investment recommendations, but only on an hourly basis, so they can get the same kind of quality work.
Okay, that's great. I'm going to put up your website and telephone number in case anybody, viewers, want to contact you. At no obligation, and you can guide them in the right manner. And that's a very volatile area of financial planning. All righty. Thanks a lot for being here, Steve.
Thank you, David.